Hello, and you're welcome to a special episode of Global Business Insights where we bring you ideas, answers, and discourse on the topical issues focusing on finance, business, and macroeconomics. We also will be featuring the latest jobs data that just came out ahead of next week's United States elections and the latest PMIs for Nigeria for October. Just out in the US, job creation in October increased by 12,000 for the month, down sharply from September and below estimates for 113,000 jobs added. Jobs added slowed to its weakest pace since late 2020 as the impact of storms in the southeast and also the significant labor impasse at Boeing dented hiring plans. Still a big downside surprise. Nigeria's Stanbic IBTC S&P headline PMI dropped to 46.9 in October from 49.8 in September and signaled a marked deterioration in business conditions that was the most pronounced since March 2023. Central to the worsening business environment in October was an intensification of already strong inflationary pressures. Overall, input prices surged higher, with the latest rise the third fastest in the survey's history. UK October manufacturing data, that's the PMI, slipped into contraction at 49.9. A lack of market optimism, slow economic growth, stretched supply chains, and concerns about the impacts of possible announcements coming from the UK budget led to a near stalling of output growth. China's factory activity swung back into expansion in October. The Shaixin S&P Global Manufacturing Purchasing Managers Index came in at 50.3 in October, beating estimates, also higher than the 49.3 September read. Euro area inflation accelerated more than expected. We saw October CPI rising 2% from a year ago, up from 1.7% the previous month and higher than 1.9% forecasted. Change in the US Fed's preferred inflation metric, the Personal Consumption Expenditure Price Index, inched down to 2.1% in September from 2.2% in August. The core PCE price index increased 2.7%, the same as in August, but higher than forecast of 2.6%. The Fed expects the core PCE print to come below its 2% target next year. U.S. citizens filing new applications for unemployment insurance rose to 216,000 for the week ending October 25. The print was lower than forecast and the previous week's read of 228,000. In the UK, again, more reactions on this week's budget, which largely confirmed expectations. A sell-off in UK government bonds intensified, however, as investor worries over additional debt and higher UK borrowing costs continue to be a concern. Siobhan Haviland, that's the Director General of the British Chamber of Commerce, called it a tough budget for business to swallow, also warning that the £25 billion increase in national insurance on employers will discourage hiring and improving wages. Moody's also said the budget leaves only limited buffers to absorb unexpected shocks. Also in the UK, growth in house prices was just 0.1% in October after rising 0.6% in September. Microsoft finished the day yesterday down 6%, while Meta fell 4.1%. The S&P tech sector was off 3.2% on the day. In the end, all three major indexes finished October in negative territory thanks to unmet high expectations and some profit-taking in the big tech sector. We could see some buying the dip today as Amazon posted stronger results after markets closed yesterday. First, we look at the latest Nigeria PMI data for October. According to the comments by the head of equity research at West Africa Stanbic IBTC, private sector activity worsened further in October, with the headline PMI settling at a 19-month low of 46.9 points from 49.8 in September. The main driver was intensification of already strong inflationary pressures, currency weakness, and higher prices for fuel and transportation, resulting in fewer new orders and less business activity. 3 of the 4 monitored sectors saw output fall, with only the agriculture sector bucking the wider trend to record a rise in output. Currency pressures and high interest rates are further intensifying pressure on the private sector, implying that the non-oil sector's growth will remain weak, although improved crude oil production relative to the prior year may still make up for this lackluster non-oil sector's performance. The central bank PMI data released its own output. That was on October 2nd, and that was the September 9th to 13th survey, which showed the composite PMI for September 2024 at 50.5 index points, indicating expansion in economic activities for the second consecutive month, up from 50.2 in August. The sectoral breakdown, according to the CBN, shows that the services sector recorded expansion for the 4th consecutive month, while the agricultural sector registered expansion for the 2nd consecutive month. The industry sector, though contracted, registered a slower contraction when compared to the level recorded in August. Nigerian government has a vision of moving towards a gross domestic product growth rate of 7% by 2027, also lifting 100 million people out of poverty. The Statistics Office had said it would be rebasing its GDP and inflation computations this month, as the federal government also refortified its cabinet, hopefully to catalyze faster growth. As it builds investor confidence, improve autonomous FX inflows, there is optimism that inflation at 32.7% in September may have turned the corner, with signs that food inflation may also be abating somewhat, and hopefully the central bank can begin to consider bringing down interest rates, now at a crippling 27.25%, far too high to support growth in the real or non-oil sector, struggling to pick up. Still, there has been some resilience, as real GDP grew 3.19% in the second quarter, higher than 2.98% in Q1, but that again was due to higher crude oil and condensates production. IMF, in their latest forecast, reduced GDP growth to 2.9% for 2024 from 3.1%, compared to CBN forecast of 3.4%. EVI had initially forecasted GDP growth of 3.2 to 3.7%. It's looking more at the lower end of that range, with risk more to the downside. Still in Nigeria, state governors have asked for the withdrawal of legislation to amend the nation's tax laws, dealing a blow to President Bola Tinubu's bid to increase revenue to plug a widening spending gap. The National Economic Council called for more consultation on 4 tax bills currently before lawmakers. That means fiscal pressures are not about to abate soon. US October total non-farm payroll employment was essentially unchanged, adding just 12,000 jobs, and the unemployment rate was unchanged at 4.1%. Average hourly earnings was up 0.4% from 0.3%. That's month on month. There were so many revisions. The August data was revised down by 81,000 from 159,000 to 78,000, and the change for September was revised also down by 31,000 from 254,000 to 223,000. With these revisions, employment in August and September combined is 112,000 lower than previously reported. Also, some downside risk may have manifested, with the numbers possibly distorted by the 2 recent hurricanes and the strike at Boeing. The October jobs report is unlikely to change the Fed's interest rate trajectory when it meets November 6th and 7th. 50 basis points much less likely, but still a 25 basis points cut remains on the table. Unemployment not going up is more of a positive signal, while the dismal jobs added report may be seen as noise, given the distortion effect. With the US economy doing relatively well, labor market robust, and with the latest ADP's private sector jobs report beating estimates with a whopping 233,000 increase, the non-farm's payroll read could have been the icing on the cake for the incumbent administration, but it is not. Equities futures inched up, however, after the data was released. As we reflect on the latest big tech Q3 announcements, a few things come to mind. First, AI is still the big driver of growth, but the huge capital outlays and expenses are eroding margins, and significant draw on cash flow, combined with the lingering uncertainty on timing and scale of payback, all amid tepid consumer appetite. All these are causing concern. Beyond beating their estimates, tech companies need to present a more convincing outlook given all the good news already priced in. Amazon stocks were up in late trading yesterday, reporting earnings of $1.43 a share, above analyst estimates for $1.14 a share on revenue of $158.9 billion, also a beat. Q3 revenue for the cloud business in Amazon surged 19% to $27.5 billion, but Q3 capital spending spiked to $22.6 billion from $12.5 billion last year. Amazon could spend up to $75 billion in capex in 2024. For Apple, earnings per share at $1.64 was higher than $1.6 as estimated. Revenue also at $94.93 billion beats $94.58 billion estimated, while iPhone revenue beat expectations at $46.22 billion. Mac, iPad, and other products and services all reported less revenue than expected. Apple expects growth in the December quarter revenue to come slightly below Wall Street's forecast. Alphabet and Microsoft both reported stronger than expected results in their cloud computing businesses earlier this week. Microsoft fiscal first quarter earnings at $3.3 a share beat estimates of $3.1, so did revenue of $65.6 billion. But guidance was lower than expected, also forecasting increases in capital expenditures tied to artificial intelligence. Microsoft's capex bill was a staggering $14.9 billion in the quarter. That's a 50% boost from last year. Meta Platforms also posted better than expected third quarter earnings, but they see rising infrastructure expenses next year. Capex for Facebook parent Meta was up 36% in the third quarter to $9.2 billion. Supermicro computer stocks continued to sink after disclosing its accounting firm Ernst & Young had resigned. Ernst & Young had said it could no more rely on management's and the audit committee's representations. Nvidia is a major supplier to Supermicro, and so the markets are worried about how this affects Nvidia's revenue. Uber Technologies also down 11% after it reported Q3 earnings and revenue that beat estimates, but gross bookings rose 16% to $40.97 billion, slightly below expectations. Asia markets fell today after the Nasdaq Composite and the S&P 500 suffered their worst day in nearly 2 months, while investors awaited the Fed Reserve rate verdict. That's next week, and results from U.S. elections also early in the week. U.S. futures were higher after a big miss on non-farm payrolls data that just came out. Well, that's it from me on Global Business Insights. This is Bode Oshosami. Thanks for sharing and following or subscribing on Facebook, LinkedIn, or YouTube and X. Again, thank you so very much for watching. Have a great weekend.